Hello, my name's Charles Delastic. I'm the Managing Director of the Blue Bond Group. We've been inheritance tax specialists for more than 18 years and have helped hundreds of clients save millions of pounds on their inheritance tax planning and advice. So today's video is somewhat longer than our normal video length in that it's around 20 minutes, and basically it's trying to cover all of the steps for landlords who want to move their property portfolios, which they own personally, through a limited liability partnership, then into a family investment company, and then place the shares of that family investment company into an employee benefit trust. The main end result of all of this is that you pay no stamp duty, you pay no capital gains tax, you probably save quite a lot of income tax depending upon your scenario, and then you also wipe out the inheritance tax on your property portfolio. So that's the purpose of this video. It's not done in our normal way in that it's diagrammatically representative, but that's what it's about today. So hopefully if you find it useful, give us a like and subscribe, and thanks for listening. Okay, so this is an unusual video in that it explains diagrammatically the timelines for moving property from personal ownership to an LLP, then a family investment company, and then finally shares going into an employee benefit trust, and the main issues and reasons around that. So it's trying to string everything together so people can see the whole flow. So effectively, the problem is when you own property personally, the capital gains tax would be payable if the properties are sold or gifted away. And for many people who build property portfolios over the years, that is in fact a major issue. Also, there tends to be a high risk where properties are owned personally. Let's say a tenant dies in a property and the landlord is sued. Well, what's their liability when they own it personally? You know, somebody could take everything, including their home, all their savings, all their investments, everything, if they were sued for high enough level of amount and people were found negligent. Whereas within a company, at least, and an LLP, interestingly, at least you have limited liability to offer some degree of protection, unless of course you were seen to be criminally negligent. Okay, then also by owning properties personally, there's the Section 24 issues around the only getting a 20% tax credit on offsetting any mortgages. So usually the benefit is for the Section 24 issues is to set up a company. However, we go beyond that and say, okay, let's set up a family investment company instead. So the first step is to generally set up a limited liability partnership, and because of the risk, as previously mentioned, we will always say to clients it's better to set up a limited liability partnership than a general partnership. So we set up and do the registration on behalf of our clients, and because we also have in-house lawyers, we are able to do the whole job in one place, and we can set up a declaration of trust for the beneficial interest. Now, in layman's terms, that means the income stream. So the trust deals with the income of the property portfolio and not the capital ownership. And therefore, because we're not transferring any capital ownership, there is no capital gains tax to pay and no stamp duty land tax to pay, because we're purely dealing with the income stream. Okay, now it's also possible if people have got lower rate tax paying children, and quite often people have kids at university or who are studying. Now they have to be over 18, but you can then add them as partners for the income and use their tax allowances, which obviously is highly beneficial because they've got £12,500 of tax allowance, which you could get out completely free of tax. Another major benefit of the LLP is that you don't have to split the income 50-50. So if people own a property, husband and wife, and they own the property 50-50, strictly speaking, the income should be split 50-50. But once a partnership is set up, you can split the income in any sort of way you like, 99% to 1%, in case one of the partners is a higher rate taxpayer already from, say, a job. Now, one of the issues is of having the LLP is a separate tax return has to be done for the revenue, and that cost would be potentially £700 or so upwards, depends on the, on your accountant and what they charged you for doing that. But if you're able to offset the tax to a high degree, then it's worth it. But also the safety has to be taken into account. So for one to a few £100 a year, making sure that you haven't got unlimited liability on your property portfolio, I think makes complete sense. And in any event, if you want to then move to the putting the LLP into a family investment company, then you've got to go through that stage, and you would hold the LLP normally for at least 3 years. And this is trying to prove to the revenue that in fact the LLP is not purely a partnership just holding properties that you happen to own. It is actually being run as a business. So then we go on to setting up the family investment company 3 years after the LLP is done, and we would need to wait for 3 years, and then the question would be asked on, do you pass the 14-hour rule? So basically this rule needs to be passed in order to claim incorporation relief. In other words, are the people who are running the company, potential company, doing at least 14 hours a week of work in the property? So if somebody, generally speaking, we think there's a 6 properties rule of thumb, and HMRC say, right, you got 6 properties, they don't tend to look at it much further, and therefore you will get incorporation relief. If you've got less than 6, then they would ask you to prove that you passed the 14-hour rule. Now, if you've got HMOs or you've got furnished holiday lets in your portfolio, or for whatever reason you're doing more work than average on a particular property and you believe you're going to pass the 14-hour rule, then you don't need the 6 properties. But it's not a question. So for sometimes clients will just go out and buy 2 more cheap properties just before they, the year before they claim the incorporation relief. And obviously, because of the 3-year timescale, you've got time to do that. Now, when the properties transfer into the family investment company, the capital gains tax transfers from the properties to the capital shares of the company. And therefore there is no capital gains tax to pay. And because you're claiming incorporation relief, there is no stamp duty, land tax to pay either. So we would set up the company and register it on your behalf, and effectively, produce all the articles of association and everything else you need for a family investment company. Now, when the properties get moved into the family investment company, then you will need to pay normal conveyancing fees. And interestingly here, because you're on both sides of the fence, you will need 2 firms of lawyers. One to act on your behalf as the person passing the properties personally from the LLP into the company, and another firm of lawyers to act on behalf of the company, even though both are the same place. It's just the issue to do with the Law Society and how lawyers work. So you'd need 2 sets of lawyers, and thankfully we will be able to recommend those on your behalf, lawyers that we've worked with for a fair length of time, and go from there. Then, of course, the question then arises around the income tax. Although you do get a Section 24 advantage in a family investment company, it's not necessarily the case now that income tax could be at 25%, corporation tax could be at 25%, and then you also have to pay dividend tax to take the money out, that if you want a lot of income out of your company, you may be better off holding some properties outside of the family investment company, in which case we would maybe need to set up a second LLP, because we can't convert part of the LLP, we have to convert all of it or nothing. So that's again extra complications that need to go through the process. Then eventually, let's say the properties are owned by the family investment companies. Well, what can you do? Well, You can put some properties in exchange for director's loan. For example, if you've got a scenario where you've bought a property and you've not held it a long time and it's got a very low capital gains tax gain or none or possibly a loss, you can transfer the whole value in. So let's say somebody bought 2 properties at 500,000 a year or 2 ago, there's been no gain, they can pass £1 million of property into the company in exchange for directors' loans, and obviously then can extract money from the company free of tax over time. So that is one of the benefits. Now, you can also exchange for redeemable preference shares, and in some cases this is also beneficial, whereby people want to pass the redeemable preference shares into the employee benefit trust, because you can get the money out of your estate immediately, as opposed to giving directors' loans away. If you give a director's loan away to your children, you have to live 7 years. If you pass the redeemable preference shares into the EBT, it's immediately outside of your estate. So sometimes people do it that way. Again, when the FIC is set up, the whole point is to have different share classes. The original capital shares, which is the value of the properties when the properties went into the company, are frozen, and those shares are generally passed to the EBT, and those shares are usually owned by the original owners of the property. But then you have income shares, which are used to pay dividends to the whole family. Now, if you've got children under 18, you can't give them dividends if you are the settler of the original company and you own the properties. You have to wait until your children are over 18. But, however, if you're adding grandchildren to the company, then they can get dividends from the company straight away if it's the grandparents who are setting up the property portfolio. So usually then any future growth in the company is allocated to the children and grandchildren, which is why you're able to freeze the value of the original capital shares. So it's not frozen per se, because you could sell assets and lose value in the company, but generally speaking, any future growth in the company is passed to children and grandchildren, and therefore would be outside of the original owner's estate anyway. So a family investment company is run like a normal limited company, and all the taxation is exactly the same as a normal limited company, and everything runs once it's set up like a normal limited company. And as we've stipulated in previous videos, the main difference is the ability to set up lots of different share classes, and also restrict the ownership of the shares of the company, and also set into different things that you want to happen in terms of control of the company. That's what you're paying for, the legal fees, when you set up a family investment company. So then eventually the redeemable preference shares and the capital shares could be passed into the employee benefit trust, and effectively those frozen capital shares are immediately outside of the estate. So unlike a normal personal trust where you have a limit of 325,000, or else you pay an additional tax of, you pay immediate tax of 20% if you put more than 325 into a personal discretionary trust, here there is no upper limit. You could literally put 10 million shares in. Okay, and the other benefit is that there's no 7-year waiting period. Those capital shares are immediately outside of the estate. Also, in addition, there is no periodic charges on an employee benefit trust. So a lot of advantages to doing it that way, as opposed to putting shares into a discretionary trust. Now, when the shares go into the trust, we claim holdover relief, and therefore the capital gains tax is deferred. How long is it deferred? Well, until the employee benefit trust gives the shares away, which we would urge people not to do during lifetime. And effectively, those shares are held until the original owners of the properties die, and then because the CGT has been deferred, that capital gains tax dies when both the owners of the property dies, and at that point those frozen capital shares are then distributed to the children and grandchildren. Now, the employee benefit trust lasts 125 years, so sometimes even the growth shares, which have been growing in the children's names, could then be passed to the same employee benefit trust once the original shareholders have died. Main point is, and this is where people come unstuck with employee benefit trust, is that you must not take any benefits from that trust while the original settlers are alive. But there's no need to do that, because all it owns is the capital shares, which is a value. So providing you don't want to shut down the company and get rid of everything, there's no need, because all the income comes from the income shares and all the growth goes to the growth shares. So there is no need in nearly everybody's case to do anything with the shares while the original settlers are alive, and it achieves the end result. And this whole mechanism at the end of the day achieves the end result of going from here to here by paying no capital gains tax, no stamp duty, land tax, no inheritance tax, and probably, because of their section 24 advantages and also the ability of a company director to pay into pensions, there could be significant income tax savings as well. So very, very good planning for the right types of people is the end result. Okay, so that's family investment companies. If you need help on this, it does need experienced advice. From listening to this advice, you can see that there's a lot of parts to it, and there's a lot of moving parts, and all of it needs to be adjusted according to each family individually. So that's how you move property personally, from owned personally to an LLP to a family investment company, and eventually the shares into an EBT to get all of the value out of your inheritance tax while still retaining the income from your property portfolio, as long as you live from the dividends or possibly return of directors' loans. Hopefully that all makes sense. If it does, please give this video a like, subscribe to the channel if you choose to do so. If you want help in this area, please give us a call and we will talk you through it all and go forward from there. Thanks for listening. Bye for now.